Vinay Jaising, MD and Portfolio Management Services at JM Financial is with us on the show. Vinay, afternoon, and thank you very much for joining in. Now, Tata Tech IPO has been the toast of the town this week. In the first hour itself, it got oversubscribed. And already now, I think at last count, it's up 8-9 times in terms of a subscription. And we're still, halfway there. So this has put the spotlight on the entire ER&D sector in India, which helps manufacturing verticals like automotive, aerospace, defense, etc. Now, there are various listed players, KPIT, L&T Technology, Tata Elxsi, Cyient. Can you talk about the ER&D space? Because the stocks have run up. So where is the value now? What is the opportunity?
So it's a very interesting question you asked. We were discussing this in our morning meeting today as well. KPIT has a run of almost 30-35% after being one of the most expensive stocks in the IT service industry. But just we slow down a bit and look at what's happened to the growth for these companies. We're looking at the IT sector growing at somewhere close to 6 to 8% for this year, and the entire ER&D space would grow closer to the 15 to 20% growth. You have companies like Persistent, which will grow at 20 to 25%, Tata Elxsi a little slower. You'll have companies like Cyient grow again in the 20 to 25% range, and then you have KPIT, which would grow at about 35-40%. Our analyst believes, Tata Technology would probably be, growing at somewhere between the 15 to 20% range. So clearly, KPIT, Persistent, and Cyient have better growth trajectory than Tata Technology as far as numbers are concerned. Now, we don't know a price of Tata Technology. We can just guess, what it is. But, based on whatever our reading is, there's a chance that the stock would probably, come at 50 times one-year forward earnings on the first day of listing itself. And that's exactly where KPIT is. And KPIT has a far robust earnings growth. But keeping valuations into consideration, our preference is really on Persistent, which gets a lot of cloud-enabled technology with you, as well as Cyient, which is much more cheaper. It's got a DLM angle as well, the manufacturing bit, and its growth is pretty robust at 20 to 25%. So pretty happy at this space. Lots of run-up, but I think still more moves as far as we are concerned to Persistent as well as Cyient.
All right. Hi, Vinay. Good to hear that thought in there. So on KPIT, you wouldn't add at current levels, and Tata Technologies on listing should be at around 50 times, or your preference leans towards Persistence as well as Cyient. But since we're talking about the Tata Group, let's talk about Tata Motors. There was some buying out there because obviously of fundamental reasons. But the other possibility could be that those holders of Tata Motors, they had a preference with regard to this issue as well. What's your view on the stock? I mean, it's seen a big run. In the last 3 years, I think from the lows, well, it's more than a 5-bagger. We're talking about a frontline nifty stock. Your take?
So, we've discussed the stock a couple of times in this interview. We are proud holders of it. The simplest way our analyst makes the story for us is twofold. One is it's one of the cheapest auto companies trading at an EV/EBITDA multiple of about 4.5. Most of the other companies are trading at 10, 11, 12 times EV/EBITDA multiples 1 year forward. It had an issue historically on Jaguar, wherein the company was generating a lot of negative FCF, and now Jaguar's turned around and you're seeing a lot of positive cash coming from them. Interestingly, next year, you'll have Tata Motors being net cash positive as a company as a whole. So attractive valuations, good FCF plus Tata Technology listing, which could add to about 10% of the overall current market cap of the company. Most of the analysts will be putting in 20 to 30 rupees per share. As far as the contribution of Tata Technology is concerned, you would see probably that itself number double up, and you would see and others, people in the future putting in as much as 60 rupees a share contribution purely from Tata Technologies for Tata Motors. So we are excited. One of the large caps we are holding on and even buying at today's level is Tata Motors.
I remember, Vinay, hi, good afternoon. End of last year, I think it was, we were looking at doing a piece, and at that point, based on the previous 10 years, Tata Motors actually was one of the worst performers in terms of nifty stocks. It's done 75% this year, and now it's of course, done well. But even now, it's only 10% higher than the peak we saw in Tata Motors in 2015. So, of course, over long periods of time, It's maybe it's all relative, right? So relatively, what do you like?
Select the right stock at the right time.
Yeah.
I mean, just think of the problems you had earlier was all about Tata's going global.
Yeah.
And the global Jaguar valuations of Jaguar, but any other company in Europe as well, the valuations are trading at 1.5 to 2 times EV EBITDA. Now when we talk about 1.5 times to 2 times EV EBITDA, what we're saying is that the company will stop in a year or two, or it will be generating so much of negative FCF that it's really burning money. The story is totally changed altogether in the last year and a half.
Yeah, no, absolutely. I'm just checking when did Tata Motors, I think they bought this in 2008, right? I mean, I think 2008, 2009.
That's exactly the period of time you're looking at underperformance. Finally they're getting their limelight.
I remember
Let them be in the sun.
I know, absolutely. I mean, the famous Chorus acquisition. I don't remember. I don't have clear memories of the JLR acquisition and where I was that day. But for the Chorus acquisition, I was in the studio and we were reporting on that particular transaction. But there was a different market, different kind of mindset back then. It was all, as you said, about India going global for the first time, going out there, buying these iconic big global companies. Of course, we've come a long way since. Vinay, what else are you doing? I mean, some of the stuff, we've spoken about specialty chemical companies that you like, names like Tattva Chintan. There's, I think, Archean, something we've discussed in the past. Anything new you've added since we last spoke? Or are you looking at?
Probably two more names we are looking at. We're looking at Blue Jet, and we're re-looking at Viatech Wabag, one in the capital goods sector, one in the healthcare and specialty sector. Very quickly on Blue Jet, here's a company again which has just got listed. Very strong cash flows. The company has three verticals of business. First is the ink used for CT scans or X-rays. The second is they make sweeteners, B2B production, and very, very big, 1:400 is the concentration which they increase. And the third is they manufacture APIs. Again, they are one of the few companies which have an FDA approval for their fine chemical / manufacturing of APIs. Stocks trading under 25 times 1 year forward earnings, and with a 20% plus return on capital employed valuation. So we're very excited about it. Again, our heart lies on the capex story of the country. So I would keep on reiterating, that's one space we as a house are extremely bullish on. One of the companies which again has got wings in the last couple of weeks, I would like to highlight to your investors would be Viatech Wabag. It's a water story. Remember, whatever happens on the government and election, the capex for the budget in water has gone up between 7 to 8 times. There are only two or 2.5 players in the overall water industry. There's an exchange, a little bit of Triveni and Viatech Wabag. The order book size is 4 to 5 times. You're seeing execution happen from them. Interestingly, as we talk, Chennai is getting desalinated water, and we are talking about close to 400 billion liters of water being desalinated in Chennai, which will help both the industrial belt as well as consumption of drinking water at home. So pretty exciting, I would say, growth prospects for this company.
All right. Vinay, we request you to stay with us for a little bit longer. We'll slip into a short break. You come back, we'll try to get our viewers an exclusive story that we're picking up. We'll also get you excerpts from our exclusive conversation that we had earlier today with Mark Mobius. Stay with us. But Vinay is still with us, and we have kept him back to get his view on this. So Vinay, in the past, we have had a chat about mid-cap cement. So we thought it would be wise to get your view on this. Some of those stocks, I think in the past, you've spoken about Orient Cement, and there was some buzz on that front as well, though we don't have any confirmation. But that one's done well for you all. What's your view on this deal, and also mid-cap cement from here?
So our perspective, the cement industry is a play on capex. We like the capex industry. It goes with the fact that the Indian budget has increased the overall capex outlay by 5.5 times in the next 10 years. So it's a must-own space for yourself in your portfolio. You can play it via, obviously, the large cap space, and that's where Ultratech comes in. But where our interest levels lies in mid cap, there was a time wherein, Orient Cement was something we were buying pretty aggressively. Now the current valuation, we've taken a pause out here. Most of the small cap or mid cap stocks in the cement space trade between the 6 to 7.5, 8 time EV/EBITDA multiples. and you have the large caps trading between the 12 to 14 time multiples, or a little higher depending on the large cap we are talking about. So really the arbitrage which a large cap company that buys a small cap company is getting that 6 to 8 times EV/EBITDA multiple straight away at 1.5 to 2 times its price for them, which is shifting off to the 12 to 14 times multiples. So herein what we have been buying here, as you said, was Orient Cement, and now we are looking at JK Lakshmi. Again, a very similar story to any other mid-cap name, a good volume growth, 10 to 15% on the top line, a key gainer of increase in demand. Incrementally, you're not seeing too much of supply come in as much as demand. And yes, coal prices did go up. So the last quarter was not very good for the cement industry as far as EBITDA per ton is concerned. But now as we're seeing the pricing power come for the industry, you will see better EBITDA per ton in the next quarters to come for the entire industry. And small players like be it JK Lakshmi or Orient should gain on the same.
Thank you, Vinay, for joining in and providing your insights on a variety of sectors. The stock of the day is undoubtedly Honasa Consumer, still locked in an upper circuit of 20% after reporting their Q2 numbers. Mangalam first, showing